Every time you think price is breaking out, it reverses. Every time you set your stop loss, it gets hit to the pip. Then price flies in your original direction. You call it manipulation. But smart money calls it business. Liquidity sweep or stop hunts the edge smart money leverage. Let me tell you about Eli. He was obsessed with catching perfect entries. He watched price tap his stop loss again and again, like the market was out to get him. Sound familiar? He would mark support, resistance, trend lines, Fibonacci levels, and every single time, he'd see this pattern. Price dips slightly below his zone, triggers his stop, then launches 200 pips in the same direction he planned. He would sit there staring at his screen thinking. How did they know? Eli started believing in market makers hiding behind screens, hunting his little stop orders. But one day, after months of frustration, he stopped asking why me? And started asking, why here? That one question changed everything. The truth behind the stop hunt. See, what we call stop hunts, smart money calls liquidity grabs. It's not manipulation. It's how big players enter and exit the market efficiently. Think about it. If you're a bank, moving hundreds of millions in a single trade, you can't just click buy. You need liquidity. You need traders on the other side willing to sell when you buy, and buy when you sell. So where do banks find this liquidity? They find it where retail traders get stopped out. Understanding liquidity. Let's break it down like a friend explaining it over coffee. Liquidity is simply orders waiting to be filled. It's the fuel that moves the market. Every time you place a stop loss, that's an order waiting to execute. If you're long, your stop loss is a sell order. If you're short, your stop loss is a buy order. Now, picture millions of these sitting above highs and below lows. That's a goldmine for smart money. Because they know exactly where retail stops cluster. Right above that swing high. Right below that double bottom. So when price wicks above a resistance and dumps, it's not random. It's liquidity being harvested. How do smart money build positions? Here's the part most traders miss. Institutions don't care about single entries. They build positions. They accumulate over time using liquidity sweeps to fill orders in bulk. Imagine you're a bank wanting to buy the euro. You can't just buy all at once, you'd push price through the roof and lose your edge. So instead, you push price down first. You trigger retail sell stops. Those stops become your buy orders. That's the footprint of smart money. The sweep before the move. The manipulation before the expansion. The pain before the profit. The psychological trap. This is where Eli was trapped for years. He'd see a breakout and rush in, convinced he finally caught the move. Only to watch price snap back, hit his stop, and then rally without him. It wasn't bad luck. It was precision. Smart money used his emotions as fuel. They let him provide liquidity. Because every emotional retail trade is a professional's entry ticket. Eli realized he didn't need to avoid stop hunts. He needed to understand them. What a liquidity sweep really looks like. Let's walk through an example. Picture price consolidating near a key resistance. Everyone's watching that level. You see multiple rejections. Retail traders think, if it breaks this, I'll buy. So they set buy stops just above the high. Smart money knows this. So what do? They push price just above that level. Triggers all those buy stops. And simultaneously, they sell into that liquidity. That's a liquidity sweep. After sweeping the highs, price collapses. All those new buyers get trapped. And smart money rides the move down with perfect entries and minimal drawdown. Footprints of smart money, how to read them. You can spot these footprints if you know what to look for. They leave subtle clues. Sharp wicks into known liquidity zones. Price pierces levels aggressively, then rejects immediately. Imbalance or fair value gaps after the sweep. The real move begins once liquidity is collected. Structure shifts. The market makes a higher high to grab liquidity, then breaks the last higher low, confirming intent. Volume spikes. Massive volume at the extreme candle, smart money entering, retail exiting. Once you start noticing these, you'll never see price the same again. Here's where it gets interesting. Smart money doesn't just hunt retail traders. They hunt each other. Yes, even banks get played. The market is a hierarchy of liquidity. Big fish eat small fish. And sometimes, they become bait themselves. You'll see false sweeps, double traps, where one liquidity grab sets up a larger one. It's a chess game, not checkers. And if you can read that game, you start playing with them, not against them. Why liquidity is always targeted. Let's go deeper. Every price move, every candle, has one core purpose: to find liquidity. Price doesn't move because of news, indicators, or algorithms. Those are catalysts, but the engine is liquidity. When there are no more orders left to fill, the market reverses to find more. That's why the highs and lows are magnets. If you ever wonder, why did price go there? The answer is simple. There was liquidity there. It's not manipulation. It's math. How to trade liquidity sweeps, step by step. All right, let's talk practical. How do you actually trade liquidity? Sweeps without getting caught in them? Step 1. Mark obvious liquidity zones. Draw out equal highs, equal lows, and swing points where retail traders likely place stops. Step 2. Wait for the sweep. Don't anticipate. Let price run through the zone. You'll often see a sharp impulse, then a quick rejection. Step 3. Confirm a market structure shift. Wait for the break of structure after the sweep. That's the confirmation smart money has finished accumulating or distributing. Step 4. Enter on a retest or fair value gap. Once the market shifts, wait for price to return to the zone of imbalance. That's your low-risk entry with smart money. Step 5. Target the opposite liquidity. If you entered after a high sweep, aim for the lows below, and vice versa. That's the game plan the banks use. Simple. Logical. Repeatable. Eli's turning point. Remember Eli? He started journaling every sweep. Instead of getting angry, he asked, "What liquidity just got taken? Who benefited?" He stopped reacting and started observing. 1 week, he noticed something. Every time price swept a high and rejected, the next move respected market structure perfectly. He tested it for 30 days. Then 90 days. Then a year. Today, Eli isn't scared of stop hunts anymore. He waits for them. He uses them. He became what smart money would call a professional counterpart. But there's another layer few talk about. The internal liquidity sweep. Sometimes, smart money doesn't just target swing highs. They target intrastructure liquidity, the smaller highs and lows inside a range. These internal sweeps fuel short-term moves, leading up to major external ones. It's the fractal nature of the market. Liquidity on top of liquidity. Once you learn to spot both, internal and external, you start to see the rhythm of smart money flow. How smart money uses time. Now, timing. Smart money doesn't just care where liquidity sits, they care when it's active. During low-volume sessions, they'll engineer liquidity. During high-volume sessions, like London Open or New York, they'll harvest it. That's why you'll often see false moves early in the session. London sweeps. New York reverses. It's not random volatility. It's a schedule. Time and liquidity are inseparable. The 3 phases of a smart money move. Every professional move follows 3 phases. Phase 1, accumulation or distribution. Price consolidates. Orders build. Liquidity pools form. Phase 2, manipulation. Liquidity is swept. Retail traders are trapped. Phase 3, expansion. Price moves impulsively in the true direction, the smart money direction. If you can identify these 3 phases in real time, you can align yourself with the banks, not the herd. That's where consistency lives. Common mistakes traders make. Let's be honest, most traders mess this up. They chase the sweep candle itself. They enter too early, no confirmation. They confuse a liquidity sweep with a breakout. Or worse, they try to predict the manipulation. Don't. Smart money can manipulate deeper, faster, and longer than you expect. Your job isn't to predict. It's to react with understanding. Wait for proof, the structure shift, the rejection, the imbalance fill. That's how you survive liquidity games. Now here's the twist. Even after all this, you still won't see smart money. Because their trades don't appear on your chart. Their orders are hidden in algorithms, split into fragments, executed across liquidity providers. What you see is their impact. Their footprint. Not their button clicks. That's why understanding liquidity isn't about spotting a person. It's about reading behavior. The mindset shift, thinking like smart money. Here's what changed everything for Eli. And what will change it for you? He stopped asking where should I buy? And started asking who's trapped right now? Because trading isn't about direction, it's about position. Who's wrong and who's right? Smart money looks for trapped traders. They don't chase price, they trap liquidity and let it work for them. Once you start thinking like that, you stop being prey. You start being patient. You wait for the footprints, not the hype. That's when everything slows down. And you finally see the market clearly. Let's walk through one last clean example. Euro to US dollar, 15-minute chart. Price forms equal highs near a daily resistance. You see 3 clean touches, liquidity building. London session opens, price wicks 20 pips above the highs, then instantly rejects. Volume spikes. Structure shifts bearish. That's the footprint. Liquidity taken. Intent confirmed. Smart money sells into the trapped longs. You wait for the retest of the imbalance, price returns, gives an entry. Then drops 150 pips. That single move explains everything. Sweep. Shift. Entry. Expansion. Simple. Precise. Professional. Liquidity is the heartbeat of the market. Every candle tells a story of who got trapped and who got paid. Smart money doesn't fight the market, they guide it. They create the illusion of choice while steering the flow. Your job isn't to outsmart them. It's to understand them. To see the footprints and walk in their direction. Stop fearing stop hunts. Start studying them. Because inside every sweep lies an opportunity. If this helped you see the market differently, then imagine what happens when you apply it consistently. Next time you trade, mark the highs. Mark the lows. Wait for the sweep. And instead of reacting emotionally, observe with intent. You'll start noticing something incredible. You'll feel calm. Patient. In control. Because now you're thinking like smart money. You've seen their footprints. You understand their purpose. And you finally know how the game is really played. If you found value in this, drop a like. Subscribe for more deep dive smart money breakdowns. And I'll see you in the next lesson. Trade smart. Stay patient. And always think in liquidity.